Welcome to our viewers. I'm Tim Coughlin, along with Gay Truscott, and we are pleased to bring you our video presentation of Edgemoor Investment Advisors' second quarter 2023 report. Our agenda is to review second quarter 2023 market performance, to discuss the U.S. economy, to explore the Federal Reserve Bank's federal funds rate pause and future movements, to spotlight corporate earnings and financial market liquidity, to provide our outlook for the remainder of 2023, to discuss portfolio implications and actions, and to present our analysis of a couple of stocks. We begin with Gay for her presentation of current market and economic conditions and our outlook going forward. Gay?
Thank you, Tim. Stock and bond markets continued their upward march in the second quarter that ended June 30th, adding to gains posted in the first quarter and defying expectations by many at the start of the year for a continuation of weak market returns in 2023. The S&P 500 index posted an 8.7% total return in Q2, putting the broad stock market index up 16.9% for the year-to-date period. This strong performance sent the S&P 500 index into a technical bull market, defined as a 20% rise off its October 2022 low, and it marked the end of the bear market that began back in January of 2022. The Bloomberg Barclays Aggregate Bond Index, which was slightly negative in the second quarter, is still up more than 2% so far this year. Overall, the U.S. economy remains steady, with the labor market strong, inflation easing, consumer confidence rising, and economic growth still positive. The U.S. unemployment rate remains historically low at 3.6%, as employers added a healthy 209,000 jobs in June. And jobless claims also dropped in mid-July, the latest sign that the labor market remains on solid footing. U.S. inflation continues to ease, with the CPI up just 3% year over year in June, a significant slowdown from its high point of 9.1% in June of last year. This chart shows the remarkably steady decline in the inflation rate over the last 12 months. Consumer confidence also jumped to a 17-month high in July, reflecting the slowdown in inflation and fewer worries about recession. And U.S. GDP growth also continues to chug along in positive territory and is currently estimated to be 1.8% in the second quarter, down slightly from the revised 2% growth rate in the first quarter, but still solidly positive. That said, some signs of economic slowdown are emerging. The manufacturing sector has remained in contractionary territory for 8 consecutive months, while the services sector has expanded modestly. Overall inflation remains elevated. Prices for food, rent, and automobiles continue to run high, even as energy costs have moderated. Housing prices, which have also come down from their peaks last year, are still unaffordable for many, especially first-time buyers. And the spillover effect from overseas economies in slowdown or recession, like China and Germany, remains a risk. In response to these uncertainties, the U.S. Federal Reserve decided to hold interest rates steady at its June meeting, maintaining its Fed funds policy target at 5 to 5.25%, and putting its aggressive stance on rate hikes on what some termed a hawkish hold. This means that the Fed actually expects stronger growth and persistent inflation in the months ahead, which could mean additional rate hikes before year-end. Chairman Powell has emphasized that the Fed remains committed to slowing inflation to its 2% target rate, meaning that interest rates could stay higher for longer. The spotlight is now on corporate earnings and overall market liquidity as major factors in determining the course of the U.S. economy and markets in the second half of 2023. On the earnings front, analysts expect earnings for the S&P 500 to decline 6.5% year over year in Q2, which would be the largest earnings decline since the second quarter of 2020 and the third straight quarterly decline for the index. The main drivers for the earnings decline have been higher costs for labor, raw materials, and transportation. But analysts also project earnings growth to return in the second half of 2023 as cost inflation moderates, which you can see on this slide. The communications and information technology sectors are expected to be the largest contributors to earnings growth in the latter half of this year, as adoption of artificial intelligence, or AI, continues to rapidly transform numerous industries. A recovery of corporate earnings in the second half of this year could help the U.S. economy avert a recession and continue its slow but steady growth. Liquidity concerns are also weighing on markets. The Fed has been shrinking its balance sheet over the past 18 months, which has, in essence, pulled money out of the financial system, making capital less available and more expensive. Banks have responded to reduced liquidity from the Fed by cutting back on lending activities, citing the need to conserve capital and maintain adequate liquidity on their own balance sheets. So far, however, concerns about liquidity, deposit outflows, and funding costs have been mostly limited to small and mid-sized banks, meaning that continued strength among the largest U.S. banks could also help buoy the economy. Overall, recession fears have eased considerably in the last few months, as inflation has peaked, corporate earnings are set to recover, the banking crisis of last March was largely averted, and oil prices have remained low. All good news for consumers. Our near-term outlook, however, for the economy and markets is somewhat mixed. We remain cautious on equities in the near term, though our longer-term outlook is positive. The 12-month forward price-to-earnings ratio for the S&P 500 is about 19 times, which is above both the 5- and 10-year averages. So the broad market seems fully valued at the moment. In addition, this year's equity market rally has been largely concentrated in just a few high-flying technology stocks, some called the Magnificent Seven, many of which we own, including Apple, Amazon, Microsoft, and Google. But a narrow market like this tends not to have the longevity of a more broad-based rally, causing some concern for investors. Finally, the geopolitical landscape remains uncertain, with inflation and recession plaguing much of Europe, China's recovery sputtering, and the war in Ukraine still raging. Notwithstanding all of this, our long-term outlook for U.S. markets and the economy remains positive. Now I will turn it back over to Tim to discuss portfolio implications and actions, and to review 2 securities which we are currently buying.
Thank you, Kate. As we consider the current economic and market conditions, we continue to find some pockets of investment opportunity. We continue to invest in short-term treasuries and money market funds at 5% yields, and we maintain our long-term standing fundamental value-oriented investment philosophy. Today we are presenting our analysis of 2 stocks we are currently buying. One of these investments is a stock we have owned in our portfolios for a long time, and the other is a new investment decision. The first is Microsoft, and the second is Thermo Fisher Scientific. Microsoft is the world's largest independent software developer and the world's second largest company by market capitalization at $2.5 trillion. Since CEO Satya Nadella took the helm of Microsoft in 2014, he has transformed the company from a personal computer-based software business to a high-value commercial and cloud application business with a complete and integrated product set aimed at enterprise efficiency, cloud transformation, and business intelligence. Nadella's cloud-first, mobile-first strategy has accelerated the company's growth, profitability, and market share, and led Microsoft to become a leader in high-growth areas like cloud services, internet applications, and artificial intelligence. Microsoft operates in three primary business segments: intelligent cloud, 41% of revenues; productivity and business processes, 32%; and personal computing, 27%. Microsoft is currently the second largest public cloud services provider behind market leader Amazon Web Services. Microsoft's Azure cloud platform has more than doubled its market share in just a few short years to 23% of the estimated $600 billion public cloud infrastructure market. Microsoft has also been moving strategically into additional growth areas, including artificial intelligence. Microsoft invested $1 billion in startup company OpenAI in 2019, which is becoming the preferred partner for commercializing its artificial technologies. Microsoft is currently in discussions to make an additional $10 billion investment in OpenAI, which could give it ownerships of 49% of the company. Microsoft has also recently moved to significantly increase its presence in video gaming, offering $69 billion to acquire Activision Blizzard, a leading video game publisher of the blockbuster hits Call of Duty and World of Warcraft. The deal, which the U.S. Federal Trade Commission had sued to block on anti-competitive grounds, was recently cleared by a U.S. federal judge and is expected to close sometime this summer, barring any additional challenges. Microsoft enjoys a wide economic moat due to its multitude of products and services. This creates a network effect around its applications and operating systems and results in high switching costs for its customers. The company's huge commercial user base, strong customer relationships, and massive amounts of consumer data position it well to continue growing revenues and earnings. Microsoft's financial position is strong. The company has a AAA rating from both Standard & Poor's and Moody's. Microsoft shares trade at a premium to the overall market at 30 times forward earnings, and we believe this premium is warranted by the company's strong earnings and cash flow generating power, robust growth prospects, and dominant market position. Our second investment for review, Thermo Fisher Scientific, is a leading provider of life science tools and services to a broad array of healthcare customers, including pharmaceutical and biotechnology companies, academic and government institutions, diagnostic and healthcare companies, and industrial and applied science companies. The company's products and services include laboratory analytical instruments, biochemical reagents, laboratory and medical consumables, and software services for research, discovery, and diagnostics. As a result of steady organic growth and several smart acquisitions, Thermo Fisher has become the premier life science tool supplier with an unmatched portfolio of products, services, and manufacturing capabilities. Large pharmaceutical and biotechnology companies see sizable benefits in Thermo Fisher's comprehensive product line and simplified procurement process. The company benefits from broad exposure to biopharmaceutical growth without taking on too much product-specific risk. Favorable demographic trends should continue to underpin increased demand for new treatments and the need for increased research and testing from Thermo Fisher. The coronavirus pandemic reaffirmed the company's dominant position within the medical supply chain, as Thermo Fisher was among the first to market with a reliable coronavirus test needed to meet massive demand. The company's large sales force, distribution network, product portfolio, and customer breadth afforded broad competitive advantages and are the bases of its wide economic moat. The company's business mix has gradually shifted to more consumable products, which now represent 75 to 80% of total company sales. We believe this will allow the company to generate more stable and recurring revenues and cash flows, even during weaker economic environments. The current management team has been in place since 2009 and has created a strong culture of growth and innovation. Thermo Fisher's stock currently trades at 21.5 times forward estimated earnings, which is a discount to its historical average. Given the company's consistent, well-managed, and durable growth profile, we believe the stock represents a solid, long-term equity holding for our client portfolios. Gay and I have now completed our report on current economic and investment market conditions and 2 stocks we are currently purchasing. Thanks for tuning in to our report. If you have any questions or comments about our report, just give us a call.